Welcome back to Global Lens, Macro to Micro. Today, we're diving into a critical factor that shapes household finances, namely interest rates. The Federal Reserve, or the Fed, sets interest rates through monetary policy, thereby directly influencing borrowing costs and saving incentives. But what does that mean for you? How do changing interest rates impact everything from your mortgage payments to retirement savings? Let's break it down. So before we get into proper household impacts, let's quickly explain how the Fed changes interest rates. The Fed controls the price of money by raising or lowering interest rates. When rates rise, borrowing becomes more expensive, but saving is more rewarding. And conversely, when rates fall, borrowing is cheaper, but savings accounts earn less. The Fed raises rates to fight inflation and lowers rates to stimulate economic growth. As an example, the recent hike in interest rates aimed at controlling post-pandemic inflation. High interest rates equal stronger incentives to save. Saving accounts, CDs, bonds offer better returns. Households may shift from spending to saving, improving financial security. That's how rising interest rates, in a summary, will affect household savings. There's also a psychological effect. Saving feels more valuable, leading to disciplined financial planning. As an example, a saving account paying 5% interest today compared to just 0.5% a few years ago. But then what happens when rates fall? Then low rates reduce the appeal of traditional savings. Households may turn to riskier assets like stocks, real estate, or crypto. Increased spending fuels economic growth, but reduces individual savings. So how do rising interest rates impact household loans now? High interest rates means borrowing is more expensive. So mortgage, get monthly payments on adjustable rates, their loans rise. Car loans and personal loans, high rates make financing large purchase costlier. For credit card debt, variable interest rates mean higher cost for carrying a balance. And households may delay major purchases due to this higher borrowing cost. Conversely, lower interest rates means easier access to credit. Mortgages and car loans become more affordable. Businesses and consumers borrow more, boosting economic activity. As an example, the 2020 housing boom was fueled by record low mortgage rates. Now, the household balancing act is, of course, borrowing versus saving. When rates are high, it is wise to prioritize saving and paying off debt. When rates are low, borrowing can be strategic, but overspending can be risky. The key challenge is that not all households have financial literacy to make the best decision. As an example, many investors turn to riskier assets when saving accounts paid almost nothing. If you look at the bigger picture and the economic ripple effects, there's millions of households adjusting their finances, thereby creating economic feedback loops. Most savings and less borrowing means slower economic growth. More borrowing and spending means short-term growth, but potential inflation. So the Fed has to come with a balancing act and watch these shifts and adjust rate accordingly. So to recap, rising interest rates encourage savings, but make borrowing expensive. Falling interest rates make borrowing cheaper, but reduce saving returns. These changes shape household financial behavior and influence the overall economy. That's it for today. Thank you for watching. If you like this video, please click the thumbs up and subscribe. And as always, if you have a topic you want me to discuss in my next video, please let me know in the comments, and I'll see you next time.